So I have a whiteboard on my screen, which hopefully I can get an adapter and be able to show you. If you want to look at the notes, I'm kind of going through the notes in order. That might be helpful if you want to open the Word document. That's on Moodle. Let's see. This one. Do y'all have any questions before we start? Good. Okay. So what is accounting? Accounting is information and measurement system that identifies, records, communicates an organization's business activities. So when you're looking at evaluating a business, there could be many reasons why you're evaluating that business. It could be maybe you're looking to invest in that business. It could be that you are looking to get a loan. It could be that you're trying to decide if you're going to expand and spend money on capital. And so you want to make sure that the information that you're given, that you're putting into the system, is going to pull to a snapshot, which is called financial statements. So during the course of business, you have transactions that happen every day. You're selling things, you may be selling products, you may be selling your services, and you're entering that into the computer. You're also buying some things. You may be hiring vendors for different things. You may be hiring consultants for things. So all this goes in. You may be investing in the, maybe you need equipment to produce a product. So you're investing, you're selling, you're buying, and all this information is being compiled during a period of time. And in the end, you want to produce reports. Those reports are called financial statements. This is what's given to banks and creditors, investors, external users that maybe want to invest in the company for stock. So you want to know that that information that's being produced is accurate. So the information has to be accurate and reliable. We'll go through that. You want to make sure that the information that you're putting in there isn't inflated. So there's a measurement. Measurement is what we're going to use in order to record those transactions, record that sale, record the cost of something. We're using that measurement. So we'll go through some of that, but we're identifying these transactions, we're recording the transactions, and we're going to produce reports that are going to be useful. Hopefully they're useful, right? If they're not accurate, they're not very useful. So you want to make, if you're making a decision on something you're looking at, you want to make sure you have all the information, correct? To be informed properly in order to make that decision. Otherwise, you might make a bad decision because you didn't have all the information. So we want to make sure we have all the information. So the users of accounting, we don't only have external users of people that we're looking to sell to, or people that are looking to invest in our company. We also have internal users. So inside the organization, you have multiple departments, right? What departments are in business that y'all can tell me in a company? I'm sure some of y'all work, right? Okay.
Just financial, or like any department?
Any department.
Operations.
Operations.
Human resources.
Human resources.
Administration.
Administration.
Supply chain.
The supply chain.
Our work is legal.
Legal.
In retail, sometimes it's called in-person.
So like a retail sales front, or usually you have some kind of sales front of some sort. You have marketing, right? You might market your department, market your business. So you have an accounting department, right? We're in accounting class, we have an accounting department. So a lot of the reports that are produced for all those departments come from the accounting department, right? And so any department that you're in, the accounting department is going to be an asset to you. So if you're in the accounting department, you may be on a side that just does analysis for the sales, and you're producing reports for the sales team. It could be that you are producing reports that are helpful for the marketing team. It could be that you're producing reports that are great for like the production team or the supply chain. You're giving them reports. So a lot of things flow through that accounting department. But anyway, there's a lot of internal users is the point. So you have the external users that are looking at the information. You also have those internal users. And when you're sending information to the management team, you want to make sure it's accurate, right? How is it useful if it's not accurate? So we want to make sure that the information that's going in is recorded correctly. So in accounting, there's a lot of opportunities, right? So we have private accounting, which we call industry, public accounting. So I have a CPA license, so I can work in public accounting. I don't, I actually work in industry. So I work for a company that owns a lot of real estate in the Metairie, New Orleans area. But the guys that I work for, the family I work for, live in New York. They have a bunch of property in New York as well. And so we call that industry. It's a private organization. Public is like an accounting firm. You're working with the public, maybe doing tax work, audit work, things like that. So then you also have government. So there's some government jobs, and this is not spelled correctly. Oh, I deleted the whole thing. Whoops. I guess we didn't need that. So anyway, there's government, like not-for-profit. So you could work in a nonprofit organization, or you could work for the government, state or federal levels. There's different opportunities that you can work in for that. There's also, they have artificial intelligence in here. I've never worked with AI software. I've seen it, it seems kind of cool, but I never worked at anything like that. The most techie I've gotten is I worked for an audiovisual company. So we installed all this equipment that's in here. Actually, we probably installed a lot of these rooms years ago, right after Katrina. So we had the projectors and the screens. So you have a lot of different parts that are moving. You have labor that's in there in that job, and you want to make sure you have all that right. But anyway, so that's an example of using accounting in different roles. There's many different opportunities that you can do with accounting. Okay, so we have generally accepted accounting principles. GAAP is how I'll refer to it. So we follow the GAAP guidelines usually in business. Some companies do deviate. We actually, at my organization, we do tax. So the way we record on the books is how we're recording for the tax returns. It's a little bit unusual. Most companies do follow GAAP rules. So those are just guidelines to help you know how to make your adjustments, how to record different transactions, especially for equipment that you buy or land or buildings, how you make adjustments for prepaid insurance. And so we have a lot of different things that we'll go through with that. But we want to make sure that our financial statements are three things: that they're relevant, reliable, and comparable. So we talked a little bit about being reliable because we're looking at those reports to make a decision. So you want to make sure they're reliable. You want to make sure they're relevant. Why am I going to give you a report that has a lot of information on it? Maybe it's great information, but if it's not pertaining to that person or to that department, then it's not relevant. So we make sure we produce some reports that are relevant. We want to make sure the information that we're given is reliable, and we want to make sure that it's comparable. So if they're comparing us to someone else, we want to make sure that we have the reports that are comparable to maybe another organization. Potentially we have comparables that are looking 1 year over another year. So you want to make sure you know how to pull that information to make sure the information that they're looking for is comparable. Okay, conceptual framework. And I don't know if I passed up something. I wanted to mention FASB. I thought I had it on here. Maybe it was in there that I deleted. Okay. Before we go to the conceptual framework, I wanted to talk about FASB. So we have a couple of different things that we'll use. It's Financial Accounting Standards Board for FASB. We have GAAP, which is the Generally Accepted Accounting Principles. We have the Securities and Exchange Commission, which is SEC. So I'm sure a lot of you are familiar with the term public corporations. They have their stock market is publicly held, meaning that a lot of people are invested in that company and have stock in that company. They have to turn in special reports to the SEC. SEC is who oversees to make sure that they're following the GAAP guidelines, make sure the paperwork looks correct. They're trying to oversee that because people are investing. So are y'all familiar with Enron? What happened with Enron? Yeah. So some of these guidelines came out after the Enron scandal. People are invested in companies. And so if they're not, that was the Sarbanes-Oxley Act came out of that. But you want to make sure that you're overseeing the paperwork that's going out for people that are doing investments, because if they are not reporting that information properly, which is what was happening, so if they're reporting things that are not really happening, you can really make books look good. It's called cooking the books. Have you all heard that? So you're investing, and a lot of people lost a lot of money. And so the SEC is supposed to oversee that. Okay, conceptual framework. So we have objectives, provide information useful to investors, creditors, and other users. Qualitative characteristics require information that is relevant and faithful representation. Elements defines the items in the financial statement. So we talked about that there's a lot of transactions that go into those financial statements. So those are the elements that make up the financial statement. Recognition and measurement. We want to set criteria that an item must be recognized as an element and how to measure that element. Okay, so when I talk about measure the element, meaning how are we gonna, what value is gonna go on that measurement of what the transaction was that we had. So we'll go through that in just a minute. So we have some accounting principles. We have measurement principle, which can also be called the cost principle. So it's the actual cost incurred in business transactions. So cost incurred, meaning if I go out and I'm buying a vehicle for my company, whatever I paid for that vehicle, that's the cost of that vehicle, right? So it could be just cost, and maybe it has some taxes on it. It could potentially have some delivery fees on it if I had it delivered to me or brought in. So we'll walk through some of those examples in later chapters when you buy something, if it had freight on it or not. So there's different things that go into it, but that's the cost, what you paid for something. That's how we're going to measure it. Then we have the revenue recognition principle. So we recognize the revenue of goods and services when they're provided and when they're expected to be received. So what that means is if I have an organization and I'm going out, let's say I have an accounting firm and I'm going to go out and I'm going to sell some consulting services. So I know I'm going out, I'm going to provide a service and I'm charging $2,000. So if I've gone out and I provided that service, but I didn't collect the cash that day, maybe I've decided I'm going to sell to that person on credit. So I'm in good faith going to say, okay, I'm going to provide these services and then I'm going to bill you and you'll pay me later. So what this means is that at that point in time, I provided the service. So I'm going to go ahead and record that as a revenue. I'm putting that in on the books as a transaction for my revenue. And then I'm going to set it up so that I know that I'm going to collect this cash and as a process so that we can keep track of who owes us that money later. But when I provide the service, I want to go ahead and recognize that revenue. Maybe you've come in and you've given me cash for something I'm going to do next month. In that situation, I wouldn't record that because I haven't done anything yet for that cash. I'm going to put the cash on the books. I'm going to record it as something that I'm going to owe out later. So do you understand what I'm talking about when I say the revenue recognition? Like we're going to do it when we provide the service or we sell that product. That's what the revenue recognition principle means. Then we have the expense recognition principle or the matching principle. So whenever you provide a service or a sale of a product, there's some sort of expense that goes along with it, right? It's either my time or it's my parts that I sold out. There's some sort of expense that you're going to have and you want to match it to when we have the revenue. So the revenue and the expense offset. The difference is what you made on the deal. Could be labor and parts. And so when that goes out, you have your revenue that comes in, and then you have your costs that's going out. And so you offset them and the net is what you made. Does that make sense? So the expense principle, that matching principle just means that we want to try to match that as best as possible. When are we going to expense something when I am expecting the benefits from it, right? The revenue from it or the benefits from whatever it is that I'm expensing. Then we have the full disclosure principle. So when you receive your financial statements, you're just looking at a bunch of numbers. And there's formulas you're going to learn throughout the semester. And those formulas help give you information to determine if something looks good or bad, but it doesn't give you the full story all the time, right? So we have these financial statements and they just have these numbers. And maybe I'm looking at something and it's not really making sense. So I can go in the back and they usually have notes. They're called footnotes. So in those footnotes, I can put disclosures and say what was happening, or why did I have this number here, or why did I have this number there? So you want to make sure you disclose that information so that they can understand what those numbers represent. Does that make sense? Okay, then we have some accounting assumptions. A going concern just presumes that you're going to be in business, you're not closing. Monetary assumption, transactions are expressed in monetary or money units. So we obviously are using the US dollar. We do have a lot of corporations that are international. They may represent a different, it might not be US dollars, maybe it's the yen or something like that. Then we have the time period assumption. So that assumption that when you're looking at a financial statements, when you're looking at them, you're assuming that they're for a period of time. It's going to be labeled at the top of those reports to tell you. So a lot of companies obviously run 12 months. That's a period of time, right? 12 months. It can be calendar year or it could be fiscal year, meaning maybe I'm running from June to May. So not everybody follows that same schedule. You may have calendar year, which is a 12-month period. And sometimes you have organizations that will report their financial statements monthly. Every month they produce them, that's their period, 30 days, 31 days. Or it could be that they're doing quarterly. So what happened in those 3 months? We're producing these financial statements quarterly. So that's a period of time. So we're assuming when we're looking at reports, they're for a period of time, and they'll tell you what it is on the reports. They're usually labeled. Okay, and then we have the business entity assumption. A business is accounted for separately from other business activities. So maybe I have 2 services that provide accounting, and then maybe I do party planning because I like to do that. So maybe I have those 2 businesses. Well, if I collected money from a party planning company, should I put it over here in my business that I did for accounting work? Probably not, right? You don't want to intermingle. And a lot of people that have small businesses do that. They'll put their money for their business and their personal, and it's better to keep everything separate. You don't want to have multiple businesses in one file. You want to make sure you keep them separate. That way you can't get a clear picture, right? If you're putting everything in one. Okay, so we have different types of businesses. Sole proprietorship, does anyone know what that is? One only, sole, right? Just one person. And so I decide that I want to go out and sell jewelry. So I just start selling jewelry. It's just me. I get my little supplies and I go into the craft fair and I sell my stuff. That's a sole proprietor. I don't even have to get a federal tax ID number. I can file it under my social security number. You don't have any protection with a sole proprietorship, but you can do it that way. Then you have partnership. So a partnership means you're in partnership with someone. It's got to be at least 2 people that have a partnership. So you can have multiple partners, and they will split the profit. Sometimes it's evenly, sometimes it's not, depending. But that's what a partnership is. You in business with someone else. And depending on how you set the partnership up, you could have some liability there, or you might be limited depending on how you set it up. Then we have limited liability company and LLC. I'm sure you're familiar with that. A lot of companies have LLC behind their name. So this is good because you can be a single owner and have a limited liability company. And so what happens is the organization's kind of separate from you. And so the liability, it doesn't always fall on you. You kind of limit it on the liability that you would have to bring onto you personally. It would be for the company. And the way you file your taxes and stuff is a little bit different for a limited liability company, but it can flow into your individual tax return if you're just a sole owner of a limited liability. So there's some benefits to having that over just doing a sole proprietorship. And then you have corporation, which we're going to pretty much focus on while we're in this class. So the corporation doesn't necessarily mean that it's a publicly held company. It doesn't have to be a publicly held company to be a corporation. You can have a corporation, it'll be incorporated, we have the INC behind the name. And there's a lot of benefits to having a corporation because you'll be limited on your liability. The corporation is kind of an entity by itself. And so it's recognized by itself. It files its own tax return and it pays its own taxes. So a lot of people will say that the corporation is a double tax entity because the corporation's paying tax on the income and you're getting paid out of the corporation and you're paying taxes as well. So they get you on both, right? Corporation pays and you pay. So if you ever hear anybody say a corporation's double taxation, that's basically what that means. So here's our accounting equation. Everything will revolve around this equation. Assets equal liabilities plus owner's equity. So it always has to be in balance. So if you have a transaction that affects assets, then you should have an offsetting entry. It's either going to be the same amount offsetting in the other way on assets, or it could be whatever happens on assets happens on liability. It could be split between liability and owner's equity. And so when you do those transactions, there's two sides. So double entry, if that makes sense. So anytime there's a transaction that happens, there's always going to be two things, at least two things that are affected. Sometimes it could be more. And we'll go through that in some of the homeworks to help you understand that a little better. There's some examples in that PowerPoint. We'll look at a couple of those. So if you expand it out, we have assets equal liabilities plus common stock, plus dividends, plus revenues, minus expenses. So as we start going through this, you'll understand what those accounts are a little bit better. But let's try to go through real quick, just what are some of these things. So what do you think an asset is? An asset, let's see if it has a, let me see if this has a definition on here of the asset. Okay. Oh, I lost it because I went bigger and I don't know what happened to it.
Yeah, there's a definition.
Oh, there it is. Okay. Resources a company owns or controls that are expected to carry future benefits. So I have it and I'm expecting it to carry future benefits. Cash obviously is one of those. So I have cash and I can use that cash in the future, right? To buy product, to invest. It's obviously going to bring me some sort of benefit in the future, but so can land, so can buildings, so can equipment. That's an asset. Asset could also be, I've sold my product on credit and I have something called accounts receivable. That means I have all these accounts and I'm going to receive accounts receivable. Remember that accounts receivable means I'm going to receive money in the future. So I've sold products, I've sold services, and I have all these accounts and I'm going to receive money from them in the future. That's an asset because it's going to have a benefit to me in the future. Sold now on credit, have them sit there and I'll be able to collect that money in the future. Okay, what is a liability? Like I'm liable to pay. So let's read the directions. I mean the directions, the definition. So it's a creditor's claims on assets. These claims reflect obligations to transfer assets, provide products or services to others. So I have a liability. I can have accounts payable. So maybe I bought a bunch of products from different vendors. So those are all accounts and they're accounts payable because I am liable to pay out in the future. So you can remember it that way. Accounts payable, I'm paying something out in the future. It's a liability, which means I'm liable to pay. So you're going to have money that you're going to receive through accounts receivable, and you're going to have money you're going to pay through accounts payable. Yeah.
Okay, this may be silly, but with a liability, because the accounting equation is liabilities plus equity, is a liability a negative number? Mm-hmm. Okay.
Yeah. So it will sit as a credit. So, and we'll kind of go through that a little bit, and throughout the semester, you'll hear me say, oh, what's the normal balance? Is it a credit or a debit? So yeah, liability is a credit. You have a question?
Yeah, is a liability kind of like prevalent whenever you have a third party retailer? So like you buy a bunch of stuff and you have to resell
So yeah, so if you buy stuff from them, you're liable to pay them for that stuff, right? And then you resell it and you receive the money in on your end. So, right, so they would be like a vendor. You're buying stuff from them, from that third party, and then you're reselling it. So a reseller will have a special certificate, just because you brought that up. They'll have a special certificate because whenever you buy something, you have to pay sales taxes. Well, a reseller, meaning that I'm buying something from you and reselling it, won't have to pay sales tax. So I'll buy it from you at cost, and then I'll sell it to the consumer, and they'll pay the sales tax on it. Does that make sense? That's what, that's a reseller. So yeah, so it's a liability. It could also be that, you know, you have a liability could be not only money. So let's say I got paid to do that service, but I haven't done that service yet. So that's a liability as well. So I'm liable to provide a service for you in the future because I've already collected my money. I've already traded and got an asset of some sort. And now I'm liable to provide those services or provide those products. So that could be a liability as well. The taxes that we were talking about, the sales taxes. So when I collect from you, when I collect the sales tax from you, I don't get to keep that money because it doesn't belong to me. It's not my money. So if it's $10 that I've collected, I'm not going to consider that income because it's not part of what I sold. I'm just collecting it to pass it on to, in Louisiana, it's parish and state. So we have to pay those parish and state. So whatever I collect from you goes right to them, same exact amount. So we'll have that. We'll have wages payable. We'll go through wages too. Okay, then we have equity. So equity, if you notice, the expanded equation has the common stock in there. It has dividends in there. So the equity is the owner's claim on assets. So it's assets minus liabilities, right? So we can solve the equation algebraically and change it, and we'll have assets minus liabilities as equity. So it's also called net assets or residual equity. So it can increase from the owner's investments and the revenue. So remember I said that we collect the money and then we also have expenses that go out, and that net is what you've earned. That's your net income. So we'll get into a little more detail of that later, but basically that net income is what you make for that period of time. And every time we start a new period, so that 12 months, every time we start a new period, going to clear that out so that the next year we can see, okay, we made this year, we made this year. So it will clear out and go into something called retained earnings. That retained earnings is an equity account, and it'll stay in there. So you can have a loss or you can have a gain, depending on how your business was, and it'll just roll into there. We also, with corporations, want to pay out dividends. That's what it's called when you receive some money that's from the profits of an organization. You want to receive dividends from a profitable company, and there are mandates on what they should be sending out. So that's monitored as well. You can hold back some of those monies in order to invest, but you usually have like plans to invest. There's some money that can be held back, but they want the corporations to pay their shareholders their dividends. So the dividends is just your portion of the company that made money. Okay, so that's going to come out just like an expense does. So remember I said we have the money coming in from sales and we're deducting the expenses to get a net, but then we're also going to deduct what we pay out. So then we make a little bit less. Does that make sense? So we have the income, we pay out the expenses, pay out the dividends. We may get investment, so that just means that I took some cash and I invested in a company, and so now I'm trading. So instead of getting cash, now I'm getting stock. Okay. Okay, the 4 financial statements. We have income statement, statement of retained earnings, the balance sheet and a statement of cash flows. So the income statement is just that, right? It shows the income coming in, the expenses going out, and it shows our net income, which is that net at the bottom. The statement of retained earnings is just showing what happened during the year. So we'll have a beginning retained earnings from last year. Remember, I told you we close it out, we roll it into the retained earnings. So we'll have that number, but then during the year, we'll have some things that happen. So the retained earnings, we'll have a formula for that to get to the ending retained earnings. And that we'll have a statement for that. And then we have a balance sheet. So the balance sheet shows that equation. It's assets, liabilities, and owner's equity. And so sometimes they will list assets on the left, and on the right are your liabilities and your equity accounts. The two should match, right? Because assets equal liabilities plus owner's equity. Sometimes they're on top, like just right underneath, but sometimes they're side by side. And then we have the statement of cash flows, and it's just that. It shows your cash coming in and out. We'll get to that at the very end of the semester. And then here's the formula that you'll need. You'll have a problem with it, return on assets. So it's a profitability measure, because remember I told you you can use certain formulas just looking at the numbers to get an assessment of how the business is doing. So this one is return on assets or return on investment. And it's useful when you're analyzing and forecasting your activities. So the formula is net income divided by the average total assets. So you would just take the two assets, beginning and ending, you know, for the 2 years, and then you would divide by 2. So you'll have a homework that has that. Let's look at these little transaction analysis on the notes. Could be very helpful. They're showing, remember I told you there were 2 sides. It's always going to be 2 sides. So if we have the formula asset equals liability plus equity, we could have a transaction where I receive cash and I exchange it for stock. So somebody invested in the company. They gave me cash, I gave them stock. So I have 2 things happening. So it's increasing my assets and it's increasing my common stock. Okay, so when you put them into the formula.
What number are you on?
B1. So we would have cash and we have the owner's equity, the common stock. So that's just an example of one transaction, but we're showing it on both sides. And then if you look at number 2, we're buying supplies for cash. So my supplies are an asset because I'm bringing something in that I can use that's useful to me in the future. Have these supplies, but cash is going out. So I could have cash going out, which would be a credit to cash because assets carry a normal debit balance of usually a positive number. And so when it goes out, it's a negative, it's credit. So I'm crediting cash, but then I'm getting supplies. So I'm adding supplies. So I have two transactions, right? 2 parts of the transaction, and they're both hitting the asset. So in the end, the equation's still in balance because I'm adding and subtracting. So you kind of get this concept. Purchase supplies on credit, number 4. So I'm adding supplies, which is an asset, and I'm buying it on credit, which means I'm liable to pay in the future. So that's going to increase my liabilities. Well, remember she said that she asked if it was a credit. It is a credit. So even though it's a credit, I'm increasing my liabilities because the normal balance is a credit. So sometimes that can be confusing. So it's increasing, but it's a negative number. So it's going to be a credit to liabilities, which is an increase to liability. As I pay that liability, then my cash goes down because cash is going out. So it's decreasing an asset with a credit. But I'm also decreasing my liability because now I'm decreasing down something that's normally sitting as credit. So I'm doing a debit for liability, but it's decreasing my liability account. So some of the homework is going to help try to understand those transactions. Okay, Do y'all have any questions? Let's just look at Connect real quick. Let's see if I'm still able to move around. I might have waited too long. Maybe it kicked me out. So I want to open the homework so you can see what it looks like. Let me stop sharing my screen so on Zoom you can see the screen behind me. I'm opening the homework on Connect. I'm gonna preview it just so you can kind of see what it looks like. So here are some of the terms that I want you to know. And this will be in the reading in the chapter, and you would just look at this, and then they have a drop-down menu. Anytime you see the arrow there, there's gonna be a drop-down menu, and you would select what the answer is. So those are pretty easy. Same here, you put an E for external user, I for internal user. Okay, identify the accounting principle or assumption. We went through those. And you would read what this says, do the drop-down menu and select the answer. And then you'll have different ones. Okay, here's the formula: assets equal liabilities plus equity. So we determine what's missing. So this is just math, right? We know that assets equal liabilities plus equity. So like on the first one, we know we're just going to add them together to get what assets are. For the second one, well, we just have to deduct the 52,000 from the 90. We take the assets less the liability. The difference is the equity, right? Just very, very simple equation. All right, so number 5 is going to walk you through transactions, and you'll have to know what accounts that transaction will hit. So let's look at the first one. So the following transactions are completed by the company. The company completed consulting work for a client and immediately collected 6,600 cash earned. So they're telling us that we received cash. Cash is really easy. We know that that's an asset. We know it carries a debit balance. So we're going to put our cash in at 6,600, and it's going to be a positive number. And then we did some consulting work, which is a revenue. A revenue is also going to have a credit balance. So when I record the revenue, it's going to be a credit. So money that I'm making is going to show as a credit. Is that confusing?
Yeah.
Okay, so it seems backwards when you first start learning, but the revenue is actually going to be a credit. On this table, they're just wanting you to identify what account is it, what's happening on both sides. So I'm increasing my revenue, even though this is going to be a credit when I do the journal entry. It's going to tell me, okay, I got 6,600 on the cash side, and I'm putting 6,600 on the revenue side. Okay, so my equation is going to be in balance. It's affecting 2 accounts, and it's increasing both of them. Okay. B says the company completed commission work for a client and sent a bill for $5,100 to be received in 30 days. So I'm sending a bill to somebody. Did I collect cash? No. What did we talk about? Do you remember what I said this is? If we have somebody that we sell something to, but they're going to pay us in the future. Do you remember what that account is called? Nope. Accounts receivable. So it's an account that we've sold to somebody and we're receiving the money in the future. So we have accounts receivable 5,100, and it's saying that we are completing commission work. So it's work that I did, which is a revenue. So then I have revenue of 5,100. All right, where it says the VAL, that's balance. It wants to know what the balance is. I'm not 100%. You may have to fill that number in. I don't know if it's going to do it automatically. So this is how you would go through your transaction. You just go through each one and put your numbers in and keep tallying up your balance to make sure that you're in balance on both sides.
So my numbers are different than the ones you.
Right. So, yeah. So that's why when I have that, you can do the question again. Hold on a second.
Oh, and you even got to check my work on here too.
You can. Sorry. I was trying to mute. Larry, can you mute on Zoom? I don't have a spot to mute that one. Oh, well, he left. Okay, so I was getting a feedback, so I was trying to see. Okay, so it's going to give you the balance, and you'll just have to make sure that you're in balance on both sides of the equation. Okay, here's another one. Okay, so I'm doing income statement I, balance sheet B, statement of retained earnings is E, and then the statement of cash flows CF. So those are the 4 statements that we went through. This is number 7 on the homework. And you're just going to select what this, transaction is, haircutting revenue. Where would that be? What statement would that be on? So it's a revenue. My income statement shows my revenues. So I would select I for that. And then you just go through and you do your drop down menu and select which one you think it is.
I'm sorry.
Yep.
Could you share your screen with us?
I can't because there was no way for me to project my computer. I didn't have the right attachment. So I had to use the computer that was in the classroom. But if you open up, if you're registered on Connect and you open the homework for chapter 1, that's what I'm looking at right now.
Okay. All right. Thank you.
Okay, so question number 8 says identify each of the following items as revenue, expense, or dividends. Again, it's telling you rental income, and I need to select from a drop down menu. What is that? Is it a revenue? Is it an expense? This one's asking what type of account it is, asset, liability, or equity, number 9. Okay, here's your return on an return on asset formula. So you would just plug it in and come up with your percentage. So it's going to give you the information. You just have to know what to choose. Remember, I was telling you that the average assets, it gives you this here, but if it gives you 2 numbers, then you would just have to average them, just divide by 2. Okay, so here's a financial statement, a little small one. So it has, this is number 11 on the homework, 11 through 14. So this is the problem that you'll finish with, and it'll give you some information. It'll tell you some accounts with balances. So this is just the account that you have in your system. These are your balances that you have, all of this here. And you'll go through and pick out which ones are revenues and which ones are expenses for your income statement. And that's what it's asking for first. And then you would just fill this in. I think that you're going to have to put the title, then the drop down will have like what account you're choosing, and then you'll have to put the amount in. Okay, does that make sense? So you're going to go through. So when you're reading through your chapter, I can't figure out how to get out of this. There we go. So when you go into the chapter in the book, it'll have some examples of the financial statements. And you want to follow that format. But again, if you have trouble, go to that practice homework and submit there, and it'll help you figure out what needs to go in each one of those cells, because sometimes that's part of the challenge. Maybe you understand what it is, but it's something not working. And then you can email me a screenshot and just text me and let me know you sent me something. Number 12 wants you to do the statement of retained earnings. So we'll start with the beginning balance. So if you go back up to the top, it gives you some information, and you'll be looking for retained earnings. If it has retained earnings, that'll be your beginning balance. On your list, you don't have one. So the retained earnings is going to be 0 for beginning balance. And then we want to add our net income. So you have to do that income statement first to figure out what your net income is. So you would add your net income, and then you would take out the dividends. So remember, out of that profit, you're paying out dividends. So it has to be deducted. And so you're looking to see what were the dividends for. You go back to your list and you look to see what the dividends were. So right here, cash dividends were $18.90. So that's going to come out of the beginning balance plus the income less the dividends will give you your ending retained earnings. Okay. The next statement is the balance sheet. So you're looking for your asset accounts, liability accounts, and equity accounts. Part of your equity is going to be your stock, your common stock, and your ending balance that you just found on the retained earnings statement. So you have to do your income statement, then your retained earnings, then you can do your balance sheet because you'll need those numbers to fill into those. Okay, and see how it's side by side? The left side, your assets, which is going to equal the liabilities plus equity. So at the bottom, they should match, right? 92,540, 92,540, because your equation has to balance. Number 14 wants the statement of cash flows. So you're going through and you're figuring out where was cash used and when was it brought in, and you're just going through your list. You'll notice on the statement of cash flows, there's 3 categories that we use. One is operating, so that's going to be anything that is part of your operations of a business. Then we have investment activities, and we have financing activities. So the investing activities could be if you bought equipment or if you have invested in land, something like that. The financing is obviously if you have a loan, could be a long-term loan, or if you've sold stock, you have shareholders that are investing in the company, so you can have that as a financing as well. So organizations will collect money either on bonds or sale of stock in order to invest in other things. They'll collect it that way. So it's considered financing. Okay. And then it just gives you your total at the end. So that was number 14. So again, you'll have 2 sets of homework, right? The one that says Chapter 1 homework is the one that is graded. The one with practice Chapter 1 shouldn't have any points, should say 0. On occasion, I might forget to take those out, but should have 0. That's just for you to practice and use. That one's open all semester that you can go back to. And the reason why is because it's comprehensive in the end. You may want to go back and practice some of those problems to familiarize yourself with some of the things we did early in the semester. Okay, so any questions? We're good? We get out early today? 7:15. I think we should take it.
I think we should take it too.
Yeah. Yes. You need help connecting to the homework? Okay, you can see me after. Okay, thank you guys.